Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the US dollar index, the euro currency, and the gold markets for Tuesday, November 1st. Starting off here with an intraday chart of the US dollar index, you can see the past couple of days sharp, again, Greece crisis-related recovery above the 76.66 corrective high from last week that we've defined as our most important risk parameter the market needed to recover above to arrest the October sell-off, define a more objective low, and re-expose and expose at least a larger degree correction higher, quite possibly a resumption of this year's broader recovery. Moving to a daily chart, you can see the scope of the past couple of days' recovery that has very quickly retraced 50% of the October slide from a 79.84 high to a 74.72 low, and clearly breaks the October decline. What remains a technical challenge is what is correcting what in this market. Might this recovery attempt be merely a correction of the October sell-off? Itself the start of a resumption of the secular bear trend in the dollar. As you can clearly see, the recovery attempt thus far from the May low at 72.69 thus far is only a three-wave sequence. Left unaltered by strength above that 79.84 high from October 4th, it's arguable that this year's recovery attempt is a major bear market correction. Moving here to a weekly log close only chart, you can see the prospect that this year's recovery is only a three-wave, potentially bear market correction within the past couple of years' major bear trend, ultimately to new lows below the April low weekly close at 72.93. That said, you can also see that by virtue of the past couple of days' recovery, it maintains the developing up channel from this year's low back in May at 72.69 and could expose or suggest that the October sell-off is merely another corrective stair-step within a major base and reversal threat to ultimately new highs above that 79.84 high from October 4th. From this intermediate to longer term perspective, we think the directional jury is out and traders have to be aware of both possibilities. But from at least the short to intermediate term perspective, clearly the trend is up and it's going to take price or weakness below that 74.72 low now from last week, which is, we think, this market's single most important technical level. As long as that low remains intact, and especially if this market produces labored three-wave corrective behavior on subsequent setback attempts, that'll swing the longer-term directional scales in terms of the broader bull. For the time being, and as a result of the past couple of days' recovery, traders are advised to move from a cautiously bearish policy to a neutral sideline one, and we'll be very watchful to see how the market trades, the manner of that of its trade when it tries to set back, and if it indeed sets back or relapses in a three-wave labored corrective bull flag type of pattern, will advise moving to at least a cautiously bullish policy ahead of what could well be a resumption of this year's broader bull trend. Moving to an intraday chart, a 4-hourly chart of the euro currency, and similarly, only in inverse, you can see the markets break below the most recent corrective low at 138 the figure. That absolutely confirms a bearish divergence in daily momentum that stems the October rally. Moving to a daily chart here, stems the October rally, breaks that rally, that uptrend, and exposes at least a steeper correction of this 131.46 to 142.48 rally, and quite possibly might resurrect this year's broader decline. It is very interesting to point out that the high last week at 142.48 was just a few pips away from the 142.57, 61.8% retrace of the entire May-October decline from 149.44 down to 131.46. It's also important to point out from a long-term weekly log scale close-only perspective, the high weekly close from late October at 141.48, still within that 141 handle area that supported the market for the middle third of the year, that had to be approached as a resistance candidate. And by virtue of this bearish divergence this clear bearish divergence in momentum, we can state that that 142.48 high not only completes the October recovery and serves as an outstanding risk parameter to all non-bullish decisions now, like long covers and cautious bearish punts, that until or unless that 142.48 high is taken out, it's entirely possible that the October recovery is merely another fairly significant bear market correction ahead of a resumption of the May-October slide, ultimately to new and potentially significant losses below that 131.46 low in early October. And for that to continue to remain the case, it'll be vitally important that this market prove labored three-wave corrective behavior on subsequent recovery attempts. And we'll be watchful for that in the days and perhaps even hours immediately ahead. For the time being, traders are advised to move from what was a cautiously bullish policy to a neutral sideline one for the time being. And we'll be watchful for any kind of bear flag behavior on interim recovery attempts that would reinforce a broader bearish count, define a tighter but yet objective risk parameter to what then will be advised as a new cautious bearish policy. Finally, moving to the December gold market, you can see the yesterday's and today overnight's failure below the 1707 spot 20 corrective low from last Thursday. That confirms a bearish divergence in momentum and defines last week's 1754 high as the end of what we believe is a very nice five-wave Elliott wave sequence that exposes at least intermediate term correction of this late October rally, and quite possibly a larger degree move south. For moving to a daily log scale perspective, you can see thus far from what we believe was the orthodox low to the October decline on the September decline, the September 29th low of 1585, not the September 26th low from 1535, but rather that 1585 is what we believe completed a wave sequence down from the 1923 spot 70 all-time high from September 6th. Up from that low, it's arguable that the October recovery is thus far only a three-wave, potentially bear market corrective sequence. But you can still see the market sustaining levels above mid-October's former resistance in the 1690 to 1700 range that now is considered a support candidate, and certainly a break below the 1604 spot 70 corrective low from October 20th is required to confirm the October recovery as a three-wave and thus corrective sequence that ultimately then could expose significant losses below either of the two lows from late September. While the market remains above generally the 1690 to 1700 range, we have to acknowledge the possibility of a broader base and reversal environment from those late September losses in a possible resumption of the secular bull trend. Moving back to the 4-hourly chart, it's interesting to note that this former resistance, specifically from the 1696 spot 80 high from October 17th, the market is holding that specific level. Also neighboring 1697 is a 38.2% retrace of this latest phase of the bull trend. We're going to be very watchful for any kind of bullish divergence and support in this 1680 to 1695 range. For recently, the gold market has gone back to its inverse correlation to the US dollar index. But if as we just discussed, the prospect for further US dollar gains, that's why we have to be watchful for a continuation of the past few days' weakness in the gold, be watchful for it to accelerate to the downside. But if this market can hold some support in this $1680 to $1700 range, it'll be interesting to see, given the resurrection of the Greek crisis and the Eurozone crisis, if the US dollar, the typical inverse correlation between the gold and the US dollar gets put on the back burner in place of or replaced by a quality flight to the gold market that has accompanied the recent stock problems and Eurozone problems. These issues considered, shorter-term traders with tighter risk profiles, given the failure below 1707, are advised to move to a neutral sideline position. Longer-term players are advised to maintain a cautiously bullish policy with a failure below 1604 spot 70 required to negate that sufficiently to warrant moving to a neutral sideline position. However, again, we'll be watchful for bullish divergence and short-term momentum in the $1680 to $17 range, and if and when the market provides such a divergence, we'll advise shorter-term traders with tighter risk profiles to move back to the bull side for what could be another quality flight to the gold market that could produce a resumption of the secular bull trend to new all-time highs above 1924. Please stay tuned to updates on these and other markets on our RJOMRT.com website, and good luck with today's trade.